on this computer. Okay, so today we're going to talk about foreign exchange and international financial markets. Probably again, some of you have seen this topic before, probably in other subjects, in other courses that you have probably taken. Okay, if you have done it, then probably it's just a review of what, a refresher of what you have actually done or what you have studied before. Right. So can you see the slides? Yeah. Right. Foreign exchange and international financial markets. So the book actually starts with a case study about how currency fluctuation actually affects the company's performance in terms of profits, and also the cost of doing business. So we need to understand a little bit about how the forex, we call it forex, foreign exchange mechanism or system works. So the few things that probably which is important that we need to understand. So by the end of this chapter, you should be able to, let me just copy the laser. So we just describe how demand and supply determine price of foreign exchange. Okay, so this probably is a review of a little bit of economics of money, and then discuss the role of international banks in foreign exchange market. This is going to be the bulk of this chapter actually, the role of not only, especially international banks or foreign exchange, especially, and finally the international capital market. Okay, how companies finance their projects or even their venture abroad. Okay, how do they get their capital from? Where do they get their capital from? And how they actually, how they affect the business. Right. I think it's very obvious that the characteristic of international business is that if you use more than one currency. Okay. For example, Marks and Spencer in UK, if they import kitchen appliances, they buy in kitchen appliances from Whirlpool Corporation in US. So Marks and Spencer is a UK-based company, UK department store. Whirlpool is actually a US company. So you need a mechanism for exchange of pounds to dollars. This is what is going on, okay, all over around the world. Okay, how they actually, you need to have, conversion system. Okay, the medium of exchange. In this case, how to convert from pounds to dollars. So you need a foreign exchange market. So foreign exchange market will facilitate the conversion of currencies mechanism, allowing efficient trade between borders that we have been, experiencing, or even we as tourists, or as travelers, we experience this as well, right? You need to actually convert, your currency, and we try to make sure that we gain, we don't lose out in terms of currency exchange. So on a bigger scale, okay, it also facilitates international investment and capital flows to find low-cost financing in capital market around the world, or to invest and get profit from your investment. So exchange rates, when it fluctuates, changes and still affects a lot of things. For example, prices that consumer pay. Okay, I think we did mention a little bit about this last week, right? Companies will have to pay more. For Japanese, if the yen, what was the question that I asked last week? in terms of exports and imports. When yen value become decrease yen value, it is they gain more by exporting. They gain more by exporting because it's cheaper, right? Of course, they will lose out in terms of importing from the Japanese perspective because they will have to pay more. Okay, in terms of for example, if they buy in US dollars, they have to pay more yen, and because the value is lower. So in fact, today money is a commodity, right? Money is commodity that is being traded around the world. So it will affect prices, consumer pay, profits of firms, obviously the economic health of countries and currencies of the country itself. Right. So first objective, how we are going to describe how demand and supply determine the price of foreign exchange. Right, foreign exchange, it is a commodity that consists of currencies issued by countries other than one's own. Okay, if a country, Japanese produce Japan, they issue yen, okay, US dollars and so on. So it's a commodity, and we're going to actually use this flexible exchange rate system in which the price of foreign exchange will be set by demand and supply in the marketplace. Okay, since it is a kind of commodity, it will the value will actually increase or decrease depending on the demand and supply of the currency in the market. Okay, in the foreign exchange market, right? And we're going to look at an example between US dollars and Japanese yen as given in the book. We look at this example between US dollars and Japanese yen. Okay. So first of all, we want to look demand for yen. Okay. This figure here, okay, this figure here shows the demand curve for Japanese yen. So this is the demand curve, and right. So the demand for Japanese yen is derived from the foreigners' demand for Japanese products. Okay, let's assume that we are actually from Japanese perspective. Okay. So this is so-called derived demand curve. Okay, derived demand curve because the demand from yen for yen is derived from the foreigners' desire to acquire Japanese goods. So to buy Japanese goods, so we need to actually foreigners need to buy Japanese yen. Okay, to buy Japanese good, foreigners need to actually buy yen. So as price of the yen falls, the quantity of yen demanded will increase. Okay, that means from so the demand for yen, the demand for yen will actually increase as the price of yen actually decrease. So the movement from point A to B on this demand curve. Okay. So this is in terms of the foreigners' demand for Japanese products. So you need more yen to actually what you call to buy the products. So to buy the product, more yen, the yen will actually reduce in terms of value. Now, the other side is the supply side. So the supply of yen is derived from Japanese demand for foreign products. Okay, so Japanese demand for foreign products, if the Japanese wants more foreign products, So they need to actually get foreign currency. So you need to get foreign currencies and sell yen. Okay, when you sell yen, so you sell yen, so you are going to supply yen to the foreign exchange market. So the quantity of yen will increase and the price of yen will also increase. Okay, so this is supply and demand, but we do not know what the price is. Okay, so as the price of yen increases or rises, the quantity supply also rises from point A to point B. So the market for yen, so what we're looking for is actually the equilibrium between demand and supply. Okay, so points along the vertical axis is the price of yen in dollars. How much yen do you need to buy, one US dollar? So this is the so-called equilibrium point. Okay, equilibrium point. So the determination of the equilibrium price of yen is the intersection of supply and demand curve, which actually gives the market clearing price. In this case, 0.009 yen, dollars per yen. Okay, or dollars per yen. Okay, $0.09 per yen. And the equilibrium quantity demanded and supplied is going to be 200 million yen. Okay, so right. And so this equilibrium price is actually called the exchange rate. Okay, this is the exchange rate. That means the price of one country's currency in terms of another country's currency. Okay, right. So there is two ways of quoting the exchange rate. One is the direct, or we call it direct quote. So the direct quote is the price of the foreign currency in terms of the home currency. It's a bit confusing, okay? I think you're aware of this, right? So, and also there is the indirect exchange rate or indirect quote, which is the price of the home currency in terms of the foreign currency. Okay. For example, from the perspective of US resident, the direct exchange rate between the US and the US dollar and yen on a certain date, okay, on August 8, 2018, was $0.0901 per yen, per 1 yen, okay, per 1 yen, okay. And an indirect exchange rate or indirect quote is actually from the US resident perspective, the indirect exchange rate is 110 yen per US dollar. It's actually reciprocal, okay, reciprocal of this. So normally US practice is to quote British pound on a direct basis. It depends on how the country will decide this. Some currencies they use direct basis, but some currencies indirect basis. So mathematically, the direct exchange rate and indirect exchange are reciprocals of each other. Okay, so you can see this in all foreign exchange tables. Okay, you can see all this. An example is actually, for example, from US resident perspective, direct quote $0.09 per 1 yen. But 1 yen is too small. It's very difficult to understand this. So the indirect quote is yen 198 for $1. Okay, I think today is 130 or 120 yen per $1. Okay, all right. Okay, so this is a table which actually shows, if you can read this on top here, direct rates US dollars needed to buy 1 unit of foreign currency. Okay, so this Wednesday, August 8, 2018, and Tuesday. So this is indirect rates, amount of foreign currency needed to buy 1 US dollar, or in any other currencies to buy, 1 euro, or to buy what do you call one Malaysian ringgit. So you have a direct and indirect exchange rates. Okay. So Malaysia is somewhere here. Malaysia, $0.24 per 1 ringgit, but 4.07 ringgit to buy $1. But now it's 4.3 ringgit to buy $1. So compared to euro, 0.86 euro per dollar. What is it the rate now? What's the rate now, Elban? Do you know? $1 euro.
Quite the same, I believe.
About the same.
It's almost the same ratio, I guess.
0.0. You can Google and just check that. But any questions? Anything direct rates and indirect rates that you can? I mean, this is common, right? In forex, in when you exchange your what do you call currency as an individual or as a company or as institution or as government buying and selling. Of course, this come at different. There is call it premiums. Okay, premium. If you buy a lot, then you probably get some so-called better rates, discounted rates. Okay. So which one do you think is easier to quote? Is it the direct quote or the indirect quote? For example, euro to South Korea won. South Korea won, right? Okay. Which is easier to in your own understanding? Which is easier to actually quote? Which one you prefer, indirect or direct?
To me, the indirect.
Indirect. For example, now you are going to buy euro, so you want to know how much euro you can get for 101, is it? This is much easier. Okay, so indirect quote. I also prefer indirect quote actually. I do not like direct quote because it become too small for my own currency. So I don't understand. 0.24 cents. Okay, here in this case 0.24 US cents or a quarter. In US we call it a quarter. So a quarter for $1, 1 ringgit. Okay, so it's easier for for me to I want to buy $1. How much do I need to get? How much does it cost to buy $1, to buy €1, for example? Okay. Right. Any questions on this? So probably a bit difficult to relate is probably this, supply and demand, because it is commodity. Okay, commodity. Quantity of yen is actually the commodity, the amount of yen that is actually circulating in the market. Okay. Right. So let's move on to which is the bulk of this chapter, to discuss the role of international banks in foreign exchange markets, the role of banks, and then there will be things like spot and forward markets in terms of foreign exchange, arbitrage and currency market, 2 and so on. So it's quite big topic. Now, so we go a bit more detail. So the structure of the foreign exchange. So foreign exchange market consists of buyers and sellers. Anyone can participate. Okay, for example, tourists buying yen in Narita Airport. Toyota export cars to Canada from Nagoya, so they have to actually, buy Canadian dollars and pay off to what do you call to the people who are buying their cars. Sorry, Canadian paying Toyota or British government loan to Bangladesh. They provide loan, they want to convert into whatever Bangladesh currency is. Okay. And you will be surprised that, well, this is like 2-3 years back, okay, 2017-18, estimated at 5.1 trillion per day. Okay, the volume of foreign exchange trading is $5.1 trillion per day. And why is that? Because all foreign exchange market opens, and when Malaysia is sleeping, US is waking up, so they're trading currency. It's the world that we live today. Nobody sleeps actually. The people who works. So volume is huge. The largest foreign exchange market is actually London. Okay, London followed by New York, Singapore, Hong Kong, and Tokyo. And approximately 88% of transactions involve the US dollar currently. Okay. So US dollar is primary transaction currency for foreign exchange market. We discussed it last week, right? So this is the map I wrote down just now. Okay. So what can you see here? Which market is the longest opening dealing times? So foreign exchange dealing times, opening, basically the market, foreign exchange is actually open for transaction. What time does London actually, from 8 a.m. to what, 4 p.m.? Okay, 8 a.m. Well, noon in London. Okay, so this is the time. Did you notice here, Singapore? How long does actually Singapore opens? Huh? Alban?
12 hours or something?
12 hours. 12 hours or something. Yeah, almost 12 hours actually. Okay. Well, normally, probably like, okay, Tokyo from 3 p.m. to like 11 p.m. Okay, 8 hours, Right. So that's why it's like around the clock. Okay. One market opens, the other close, then, so this is how dynamic the system is. Okay. So we have this time dimension of money. Money keep on moving. So 88% is US dollar, Australian dollar 7%. So currencies involved in foreign exchange market. Well, Canada 5%, Swiss franc 5%, pound 13%, Japanese and so on. Euro 31%. Right. So this is based on data from the Bank for International Settlements, right? So it's huge. So we start with the role of banks in terms of the foreign exchange market. Foreign exchange departments of large international banks such as JP Morgan Chase and Deutsche Bank in major international centers actually doing a foreign exchange, and they play dominant role in foreign exchange market because they are ready to buy or sell the major traded currencies. Well, companies have accounts with them, individuals. So there's the continuous exchange happening. Okay. So first of all, banks play a major role, and of course, why do they do this? Obviously, there must be some motives for that. Okay, right. So bank profits from the spread, which is the bidding price and the asking price. So the difference between the bid and the offer price result into profits by the bank. Okay, because you can buy at certain rate, you can sell it at a certain rate. Okay. Okay, let's do a small exercise. Just, if you have a calculator of, or you have just punch some numbers and see how much, as a banker, assuming you're working for JP Morgan. The question is this: you So the bank buys 10 million Swiss franc from customer A at this price, okay? Because the forex is like that. You are selling, if you have US dollars and you want to convert to the local currency, so you're going to sell US dollar, okay? And then you want to buy US dollar. So these are these rates, okay? So 648, there's like 649, but you're dealing with 10 million francs to customer. How much profit? Can anyone tell me how much profit does JP Morgan makes just by this transaction? So get out your calculator and do the simple arithmetic.
Is it 10,000 million? No, 10,000 francs.
The answer is in US dollars.
Isn't like $10 million profit?
10 million profit?
Yeah.
No.
Okay.
How much profit does JP Morgan makes? Anyone? So 10 million divided by 1.648, how many US dollars is that? 10 million divided by 1.648 franc per US dollar. How many US dollars is that? So you need to minus this 10 million divided by 1.649 minus 10 million divided by 1.646. Then you can get the answer. Okay. So it is actually 10 million divided by 1.6 48. So this will give you but to tell you, to give you exactly, this is exactly 6 million 6067 961.0 16. Okay. 10 million franc divided by, because it's 1.648 franc per US dollar. So this is actually dollars, right? 1.649. 649 will give you 6 million 6064. It's just 3,000 something, 3,779.8. 0281.38. Okay, so you do this and you can minus that. The answer is 3,679.78. Okay. Right. Okay. Right. So how much profit does JP Morgan makes? Well, it's just one transaction, right? So imagine, the different transaction. This is just difference of one. So that's why there are people who actually do business trading money. Have you heard of that, Alman? People trading money, buying, selling, and buying money? Or you have done this before? You have actually...
Yeah, I heard of it. Not really done it, no. But I heard of it.
Yeah, currency trading is common. Not very common, but people have to do it. In fact, actually banks sometimes act as speculators. Okay, they actually buy and sell and they make money out of it. Or even governments also buy and sell currencies and try to profit from the currency trading. Yeah. And also there is a concept of arbitrage. Okay, we'll discuss it later. Arbitrage, where you try to profit, no risk. Okay, you can actually make profit from that. Right. I think my internet line is a bit slow. Anyway, okay. So the international banks, they are involved in this foreign exchange. Okay, they are involved in the wholesale market. Okay, big customers, firms. Not only that, they actually deal with on behalf of large commercial customers. So interbank transaction typically involving at least $1 million or the foreign currency equivalent for majority of foreign exchange transactions. Okay, and also the retail market, right? So interbank transactions involve 1 million, and the majority are for foreign market. And on this, like corporate treasurers, pension fund, hedge funds are also being used for transaction. Okay, involved in foreign exchange. Insurance companies, all these are major players in the foreign exchange. Okay, they move from one market to another market and involve capital flow. Right. So banks and institutional investors in one market are in constant contact with their counterparts to seek the best currency prices so that they can actually make money. And nowadays, there's a lot of online currency trading. It's growing, huge, big. I'm not a fan of that, but online currency trading is actually quite big. Okay, and of course central banks, central bank, treasury departments, all these are actually players involved in the foreign exchange. Okay. who are the clients? Okay, because the bank also acts or do these transactions, not only for people who actually buys products or services or involved in projects, loans. There are the commercial customers, people who actually engage in foreign exchange, normal business activity, export, import, and so on. So these are the commercial customers. Paying dividend, receiving dividends or interest from foreign sources, trying to send back to their HQ. Okay, so these are commercial customers, or buying, selling foreign assets. So the first one is commercial customers, and of course, they also hedge against unfavorable changes. They actually hedge fund. Okay, they make money from buying futures market. Okay, for unfavorable changes in foreign exchange rate for monies to be paid or received in the future. So they can also hedge that. And the clients also exchange rate speculators. Okay, exchange rate speculators, deliberately assuming. So these are speculators. They take the risk by buying currencies and speculate whether it's going to move up, and they can gain that. So they attempt to exploit small difference in the price of a currency between markets. They seek to obtain riskless profits, risk-free, by simultaneously buying the currency in the lower price and selling it in the higher price market. We'll see this. This is called the arbitrageurs. Okay, currency arbitrageurs. Actually, they exploit the differences in terms of the rates between 2-3 countries. They can gain profit from that. Right. Type of currencies. There are convertible currency or hard currencies. These are freely tradable, like US dollars, euros, yen. Okay, hard currencies. So these are hard currencies. And this is the other one is the current inconvertible or soft currencies. Convertible currencies are not freely tradable because of domestic laws or unwillingness of foreigners to hold them, or even because of sanctions. Okay, because of sanctions, because of global what do you call boycott and so on. So most of this inconvertible, can you name one country in which you think it is an inconvertible currency? Sarah, do you know any? Is Sarah around? No, she's not here. Okay. Norian, can you give me one country currency in which you think it is actually a soft currency? Can you think of one country or one currency, or a country is okay, whatever, you don't maybe not know the what the country uses, okay? What's the currency?
I don't know, maybe in India.
Niger?
No, in India.
India is quite convertible. I've been to India. It's easy to get rupee. India, they use rupee, and I can get rupee in Malaysia. I can Okay, Alban, have any Russia?
No.
Ukraine.
Croatia.
Okay, Alban, any ideas? Currencies that you not freely tradable. That means it's difficult to actually get the
currency from Afghanistan, maybe.
Yeah, Afghanistan probably. probably Iraq, or one that I know of is Sudan. Actually, I've been to Sudan, and when I go to Sudan, you know, there is no banks actually. The banks, the rate of the bank is actually much. I mean, they use US dollar actually in Sudan. US dollar when you buy things. It's funny, right? It's sanctioned by the US, but the US actually US dollar is freely marketable in Sudan. It's funny. It's funny. You know? And to me, yeah. The Sudanese, they use Sudanese pound. I cannot convert it in Malaysia. I cannot get Sudanese pound. If I go there, I have to bring US dollars. So countries that you bring US dollars are actually, inconvertible or soft currencies. Okay. Or I don't know, maybe Myanmar, like in Southeast Asia, Myanmar.
Vietnam dong.
Vietnam dong, I can get in Malaysia. Vietnam dong.
Oh, okay.
I can get it. No, the thing is, if you go to the foreign market, you go to the retail, you go to the counters to actually change currency, right? I've been to Vietnam. I've been to, of course, it's probably in Europe. You cannot get dong because it's in Southeast Asia. So probably it also fall in a little bit soft currency as well. Okay, right. So this is just mentioning about the type of currencies. Now we move on to try to look at spot and forward market. Before we talk about that, we'll just think that in all international business transactions, payments to be made in the future. Okay, a lot of things are not, they on credit or things that you have to actually. It takes months to actually arrive at the port or the country. So payments to be made in the future. Whether you want to do, you need to lend the money or you purchase the money on credit. So how are you going to actually pay that? Which rates you're going to follow? I mean, the companies will try to their best to actually gain and not lose from this fluctuation in value of the currency. So fluctuation in currency, how a firm know for sure the value of foreign currency. If the value increases, then how we are going to actually use more of our local currency to pay for that. Okay. So the time dimension of money in terms of you can buy and sell it for immediate delivery or for future delivery. So these are spot and forward markets that we're going to mention. Or you want to pay immediately. So foreign exchange transaction that are to be consummated immediately, and immediately normally defined as 2 days after the trade date. Okay, but companies normally they try to pay as late as possible in terms to, especially for pay on credit. Okay, so the first three is actually related. Spot market is actually very, very easy. So very clear. Foreign exchange transaction occurs sometime in the future. So sometimes prices are often published for foreign exchange. They publish forward prices or forward what they call values. The spot market is on the spot. You buy and you actually pay for that. You buy the currency, the foreign currency, and you pay that. But forward market is actually, you may want to actually buy the currency today for delivery 1 month, 3 months, or 6 months in the future. Okay. So some users of forward market engage in swap transactions. So swap transaction is actually transaction in which the same currency is bought and sold simultaneously. Okay, so you're going to actually buy that foreign currency and also sell it at the same time. but delivery is made at two different points in time. Okay, we'll look at the example of this. So when you say, have you seen this before? Have you seen, I think it was, have you seen this? This 1 month forward, 3 month forward. Oh, it was here just now. It was in the table here. What's the table? This table. Did you notice here, Japanese yen, there is 1 month forward, 3 month forward, 6 month forward. UK pound, there is UK pound, 1 month forward, 3 months forward, 6 months forward. So these are future rates, forward prices. Okay, for example, UK pound 1.2 something, 2882. For 1 month, 2897. For 3 months, 1.2934. So the it's expected to actually increase in value. Okay. So you know you want to actually so forward market means you actually buy that in the buy it now at the what do you call future rate, right? Okay, let me just make it a bit clear. So for this, just now I mentioned the swap transaction. Okay, the book gives the example. For example, in a typical spot against forward swap, so a US manufacturer borrowing 10 million pounds from a British bank, 10 million pounds for a British bank for 1 month, but needing dollars. So he wants to sell pound for dollars. So he wants to pay in US dollars. Okay. Sorry, he wants to buy, he wants to borrow 10 million pound. So but needing dollars, will sell the 10 million in the spot market to obtain the US dollars, and simultaneously buy 10 million plus the number of pounds it owes in interest payments in the 1 month forward market to repay its pound denominated loan. So normally an international business that wants to buy or sell foreign exchange on a spot or forward basis will contract with an international bank. So the bank will charge the company the prevailing wholesale rate for the currency plus a small premium for its services. Since the bank's extensive involvement in the foreign exchange, it is typically willing and able to customize the spot, forward, or swap market, swap contract to meet the customer's specific needs. For example, if a company expects to receive 10.7 million, say for example, francs from Swiss customers in 42 days, so the bank will usually agree to enter into a forward contract to buy those Swiss francs from that company with delivery in 42 days. So it's in terms of the contract between the company and the bank. Okay. And it's customized. It's customized. Now that is the spot market is very clear. You buy on the spot. Forward market, it's a bit difficult. Okay. So in this case, this is an old data actually. So another mechanism, two other mechanisms to get foreign exchange in the future is currency futures. So publicly traded, it is actually public traded. So futures are publicly traded on many exchanges. So it is actually a contract that resembles a forward contract. So it's a contract that resembles forward contract. Okay, a standard amount on the standard delivery date. So they buy currency now. The second mechanism is the currency option, which allows a company, but does not require a company to buy or sell a specific amount of foreign currency at a specified date, a specified price on a specified date. All right. So they have this too, call option and put option. Call option grants the right to buy the foreign currency. A put option grants the right to sell the foreign currency. So for example, put and call options are available for Canadian dollars on the Chicago Mercantile Exchange in contract sizes of Canadian dollars 100,000. Okay, so I repeat, put and call options are available for Canadian dollars on the Chicago Mercantile Exchange in contract sizes of Canadian dollars 100,000, and on the Philadelphia Exchange in contract sizes of Canadian dollars 50,000. Okay, so they selling money, okay, selling money and buying money. All right. Okay. Okay, when you buy forward, okay, so if the forward price, so this is the forward discount or forward premium. If the forward price is less than the spot price, so you get a discount, okay, you get a forward discount. If the forward price is more than the spot price, you actually going to pay a premium, forward premium. We call it forward premium. So usually we use a direct quote. So if the forward price is less than spot price and the currency is selling at the forward discount, and the vice versa. Okay, if the forward price is higher, then you're selling it at the forward premium. Okay, the book give this example, which is actually calculating annualized forward premium or discount. So for example, on 8th of August 2018, the spot price for British pound is $1.2882, and the 3-month forward rate is 1.2934. And obviously, we can see here forward price is greater than spot price, so the currency is a forward premium. There is a formula to calculate annualized premium or discount, which is actually the forward price minus the spot price divided by the spot price multiplied by N, where N is the number of periods in the year. Because it is 3-month forward rate, so because 3-month forward rate, so the formula is actually number of periods in the year. 12 divided by 3 is 4. Okay, so that's why it is 4 here. So 1.2934 minus 1.2882, sorry here, divided by 1.282 times 4, so you'll get 1.61%. Okay, so it is the forward rate is positive, so it's actually giving us forward premium. Of course, it is a negative value, then it will actually give us an annualized discount rate. Okay, so this calculating, this is just showing how to calculate the annualized forward or discount for future transactions. All right. Okay. Any questions? Any questions? You understand this? do you understand this simple? This is just a straightforward calculation. Yeah? It's just given by this formula. Okay, which is the annualized forward. It's either premium or discount. In this case, it is a forward premium. Okay. Okay, we move on to another concept for the for foreign exchange or currency market. So another important component of forex is actually arbitrage. Okay, arbitrage. So arbitrage is actually riskless purchase, no risk purchase of a product in one market for immediate resale in a second market. It can be products, it can be it can be commodities, money is also commodity. So in order to profit from a price discrepancy, okay, so this is the meaning of arbitrage. So you can actually so we're going to actually explore two types of arbitrage activities that affect foreign exchange markets. One is arbitrage of goods, okay, goods, commodities per se, and the arbitrage of money. So we can actually profit from money. Okay. So the arbitrage of goods, there is the so-called law of one price. Law of one price. If supply and demand works, okay, if you manipulate supply and demand, so it won't work. So such arbitrage activities will continue until the price of the good is identical in both markets, excluding transaction costs, transportation costs, etc. So it's the price of selling the goods in one market and in another market. So if the price of good is different between two markets, well, this is common. People will tend to buy the good in the market offering the low price, the cheap market, and resell it in the market offering the high price in the expensive market. That's why you see counterfeit products. Counterfeit products. People will get it from a different market and sell it, higher. Not so sell higher, same price in the market. We look at an example. The book gives a very clear example, very simple and clear example. Okay, the arbitrage of goods also relates to this purchasing power parity theory. Okay, purchasing power parity theory, which actually states that the prices of tradable goods, when expressed in a common currency, one currency, will tend to equalize. The tendency for them to be equal across countries as a result of exchange rate changes. Okay. So PPP will occur because buying a good, a product in a cheap market and reselling it in an expensive market will theoretically affect the demand for the goods and the price of the currency. Demand for the currency and the price of the currency. Okay, demand of the currency is the currency itself and the price, the rates, and the market price of the good itself in the two product markets. Okay, so you have the money market, you have the product markets in question, right? So that's why you have this purchasing power parity. So the book gives an example, very simple, clear example. So assume exchange rate for US and Canadian dollars is $0.8 equal to $1 Canadian dollar. Okay, even it's dollar, this is Canadian, this is US dollar. Okay. Suppose that you know one kind of device, jeans. There's one kind of device jeans sells US $48 in US, and in Canada you sell it at $60. Okay, Canadian dollar in Canada. So in this case, we say that PPP exists, okay, because Canadian $60 times, sorry, they're missing 0.08, okay. So 0.08 divided by Canadian one is $48, okay. So you're paying 60 Canadian dollars, but it's actually in terms of US dollars is the same. So no reason to cross border to get the cheaper price. I don't have to go, border near the what's the nearest city, Toronto, okay, or go buy this trousers, okay, or the Levi's. Now, suppose there is something happen. Suppose Canadian firms invest in Mexico and sell currency to buy pesos, which actually increasing Canadian dollars in foreign exchange, causing Canadian dollars to fall in value. Okay, so let's say, suppose the new exchange rate is 60 cents for sorry, this is Canadian dollar. Okay, I've mistyped this. US. This is actually Canadian dollars. Let me just change this. Are you following? Can you follow? Are you following? Are you following the example? Norian, okay. You're right. So this when this happened, it is no longer parity. There is no PPP, no longer PPP, because US resident can cross the border and buy one piece of device for US $36. Okay, you can convert that, saving the guy $12, right? So US dollars, and then saving this. So the arbitrage affects these three markets. So what is happening now is that because of this, because Canadian dollars have actually reduced in value with US. So the foreign exchange market between US and Canada. So that's the first market is actually going to be, that's affected, okay? And then the market for Levi's in US, that's one, the goods market in US. And the goods, the Levi's in Canada is also affected, okay? So what's happening is that by buying in Canada, the supply of US dollars increase in foreign market, raising the value of Canadian dollars relative to US dollars. So that's why the law is actually going to reduce demand for Levi's in US, increase demand for Levi's in Canada. This behavior, this arbitrage behavior will continue until the law of one is met again. Okay, that means it will actually come back to having the same price. So PPP, the price of traded goods tend to equalize. Okay, eventually it will move and try to be the same back. Okay, initially it will be differences, but it will tend to actually equalize. But not all markets. Okay, just a little bit more on this PPP. So economists or businessmen have used PPP to compare standards of living between countries. For example, the per capita 2016, for example, Germany and Australia are converted into US dollars. For Germany, 43,050, Australia is 54,020. It's just per capita, right? But it's failed to consider differences in price levels by adjusting to the different whether it is cheaper or much more expensive. So after adjusting for PPP, you'll see that in this case we think that Australia is actually better off than Germany, but in after adjusting for this purchasing power parity, then you'll see that actually Germany having higher per capita than Australia. Okay, so they use PPP to actually compare standards of living. Of course, foreign exchanges use PPP to forecast long-term changes in exchange rates. There's, I do not know whether you have heard of this Big Mac Index. Big Mac Index. Have you heard of Big Mac Index? Yeah, it's actually, so I've got hold of one example here. Okay, it's actually providing helpful signals whether the currency is undervalued or overvalued. It's just indicative. It's not actually exact, like how much does a Big Mac cost in Switzerland, Norway, US is actually the standard. Okay, $5.28. Okay, it's a bit cheaper in Canada. It's very cheap in Russia. So this is so at market as rate exchange rates on the on this date, January 17, average of 4 cities and so on. So this is actually the Big Mac Index. Local currency, whether it is under valuation or over valuation against the US dollars, okay, or stronger in that matter, right? So this is using PPP to understand the what they call market. Another one is right. So that is arbitrage of goods. Now there is arbitrage for money, making a profit from differences of prices. So profiting from price differences in two geographically distinct markets. So that's 2-point or geographic arbitrage, we call it. And 3-point arbitrage is buying and selling of 3 different currencies to make a profit. And covered interest arbitrage is arbitrage that occurs when the difference between 2 countries' interest rate is not equal to the forward discount or premium on their currencies. So it is actually covered by, if the currency actually reduces in value, right? So this is the 3-point arbitrage, okay, example. Where the 2-point arbitrage is, the book gives an example. Suppose £1 is trading, no, okay, let me just show this first. So suppose this is 2-point, okay, 2-point is, suppose £1 is trading for $2. Okay, £1 sterling, £1 UK is trading at $2 in New York City, and $1.80 in London. Okay, so a profitable arbitrage opportunity is actually available. So foreign exchange trader at JP Morgan Chase could take $1.8 and use it to buy £1 in London foreign exchange market. Okay, then the trader could then take the pound she just bought and resell it at New York's foreign exchange market. So this 2-point arbitrage, okay, geographic arbitrage, resulted into transforming that $1.80 to $2 at no risk. Okay, 20 cents gain. So that's 2-point profit, 2-point or geographic arbitrage. Now the 3-point arbitrage, okay, is like this. Suppose that £1, okay, £1 can buy $2 in New York, okay, in New York. So the rate is $2 for £1. New York, Tokyo, and London, okay, right. And $1, you can buy $1 can buy 120 yen in all those 3 markets. Okay, so all these 3 markets is selling at what do you call this rate, and £1 can buy 200 yen in all the, so 100 yen, 200 yen. So $1 is, so this is the rates. So this is the exchange rates. So because the exchange rate between each pairs of currency is the same in each country. No possibility of profitable 2-point arbitrage exists. However, profitable 3-point arbitrage exists. This opportunity exists. So the arbitrage is buying and selling of 3 different currencies. Buying and selling 3 different currencies to make a riskless profits. So this diagram shows how this works. Okay, so you convert £1 into dollars. So you sell £1 and you get $2. Okay, so you convert that, then you sell that $2, okay, at New York market, and you get 240 yen. Okay, so you in the Tokyo market you sell 240 yen, you get 1.2 pounds. Okay, so immediately you gain 0.2 pounds from this 3-point arbitrage. Understand? Any you can see the logic of making free money. Logic of making free money. That's why you see a lot of currency traders actually. They take the opportunity and they scan. If you scan the money market, you can actually gain from that. Okay. So for a riskless profit, no risk profit of 0.2 pounds. Okay. So they use these cross rates. Okay, cross rates. Cross rates are actually calculated using a third currency. For example, in this case, £1 divided by $2 multiplied by $1 divided by 120 yen will give you £1 equals to 240 yen. Okay, so instead, so you can get, so the it's called the cross point. Okay, or the cross rate. Sorry, cross rate. The cross rate is actually £1 240 yen. Okay, right. Any questions? So the third one is actually there is an example for the covered interest arbitrage. You can if you can look at the example, in the book. Or I'll discuss it next week if I have time. Now, okay, do I want to start this? Okay, that's the final one. The international capital market. So the international bank does not only play an important role in the proper functioning of foreign exchange market, and also the the arbitrage transactions, but they also play a critical role to finance the operations of international businesses. So they act both commercial bankers as well as investment bankers. So for commercial banks, they finance exports and exports, they accept deposits, they provide working capital loans, they they offer all these financial services. So for investment bankers, they may underwrite or syndicate local, foreign, or multinational loans, or they broker or facilitate or even finance mergers, joint ventures between foreign and also domestic companies, domestic firms. And of course, they're trying to develop new products. Have you heard of Sukuk? Sukuk is actually Islamic bonds. Sukuk is very popular, to cater for the countries that doesn't accept the concept of pure interest. So sukuk, you have not heard of sukuk? SUKUK, sukuk. Sukuk is actually a product of, you know, of the Islamic what do you call, capital market. Okay. So that those are, you know, new, they develop new products that will meet the needs of borrowers worldwide. So there are this is the actually the world's major international banks. Okay, the major international banks, the world's 20 largest banks in 2017, of course. You can see here the, you know, the top three here is China, Arbitrage, France, okay, JP Morgan. But this is 2017. What do you call data? Okay. So the international banking system is centered in large money market banks, headquarters in the world financial centers, London or the Asia, US and the European Union. So the banks are involved are here. Is given here revenues ranging from 54 billion US dollar to 153 billion. So international bank, they have many forms, many forms of many different forms of international banks. So many of these most international bank was done through reciprocal correspondent relationship among banks located in different countries. So a correspondent relationship is an agent relationship whereby one bank acts as a correspondent or agent for another bank in the first bank home country and vice versa. For example, a US bank could be a correspondent for a Danish bank in the US, while the Danish bank could be the US bank correspondent, Danish bank in the US, while Danish bank in the US. So it's a correspondent relationship that exists between banks, or you can have subsidiary banks. Okay, so of course the correspondent bank will be able to perform all the different services. For example, honoring letters of credit, transferring, or even the currencies exchange. So banks must also be profit. They themselves also must make money at the end of the day in order to to sustain. And then the subsidiary bank, overseas banking, which is actually separately incorporated from the parent subsidiary bank. A branch bank is, if it's not separately incorporated, it's called a branch bank. But these are, the different kinds of forms that actually exist. Affiliated bank is actually they create as the bank overseas operation in which it takes part ownership in conjunction with a local or a foreign partner in the in the host country. Okay. And in terms of services, it can be, like I mentioned just now, commercial banking services or investment banking services. Exporters or tourists will use bank services to exchange their currencies, commercial bank services, right. Or even investment banking services, okay. Investment banking services such as package and locate long-term debt and equity funding to arrange mergers and acquisitions of domestic and foreign firms, so that they secure clients, finding the lowest possible cost, okay, finding the lowest possible rates to, of course, to benefit their clients, right. And the international capital market This is the euro currency market. Euro currency. So there's another important international financial system is the euro currency, where they actually, originally called the euro dollar market. Okay, euro dollars originated in the 1950s. The US, so they actually created create the euro dollar, okay, as a means of trying to, I think, to at least compete with US dollars at the same time. Okay, right. So euro currency is defined as a currency on deposit outside its country of issue. Okay, that is euro currency. And so the euro loan has grown up with the euro currency. So the euro loan market is extremely competitive. Euro loans are often quoted on the basis of the London Interbank offered rate, LIBOR, which is the interest rate that leading international banks in London charge each other for short-term euro currency loans. So euro loan market is often the low-cost source of loans for large credit-worthy borrowers such as governments and large multinational enterprises for three reasons. First, euro loans are free of costly government banking regulations. They are designed to control the domestic market supply, but that drive lending costs. Second, euro loans involve large transactions, so the average cost of making the loans is lower. So these are the advantage of euro loan. Third, only the most credit-worthy borrowers use the euro loan market. Okay. So during the 70s, the US banks complained that reserve requirements and other expensive regulation imposed by the Federal Reserve Board prevented them from competing with European and Asian banks in issuing dollar-denominated international loans, which at the time accounted for more than half of the euro loan market. Okay. So the foreign banks leading in euro dollars were not subjected to the regulations. So to counter this problem, in 1981, the Federal Reserve Board authorized the creation of international banking facilities, IBFs. So it's a form of competition. IBF is an entity of the US bank that is different, legally distinct from the bank's domestic operation, and may offer only international banking services. Do not need to observe the US domestic. So to counter, European euro currency market, so US actually created international banking facilities to provide loans for international banking services for mainly US companies, probably. Okay. Right. IBF also accept deposits from or to make loans to only non-US residents. However, IBF enabled US banks to compete with other internet bankers on a more equal footing, okay, in a critical euro loan market. So the international, money market is actually very, very competitive. Okay, very, very competitive. Everybody, because there is opportunity for making profits. Okay, obviously, when you provide loans, you'll get the returns. Okay, the returns on the loan that you actually provide. And companies, actually, especially developing countries, would like to get loans which offer, low interest rates. Okay, for long-term survival. Right. Okay, the international bond market, there is also the foreign bonds, euro bonds, global bonds that is being issued. Okay, by banks or financial institution to actually provide an avenue for borrowing as well. Okay. So the dominant currencies in international bond market are actually the euro and the US dollars. Right. Okay. Can I request you to actually read the rest of the chapter? This is there is offshore financial centers, Cayman Islands, Bahamas, or even Singapore. Singapore is also considered as offshore financial centers, providing safe havens for capital flights, safe havens, because of their political stability, because because of privacy protection. That's why the rulers of many countries are actually investing in this in these financial centers. Okay, right, to attract deposits and then provide lending to customers. Right. So the equity market is actually very is huge. Okay, it's huge. Okay. Right. Can I request you to actually read the section on international capital market? Okay. International capital market, the international bond market, the global equity markets, and also offshore financial centers. Okay. Right. So it's almost 11:30. Any questions that you any opinions or any questions that probably you'll have? So these are the questions. These are kind of questions that probably you need to review if you want to actually review. What determines the market for available currency? What determines the supply? How are prices established in the foreign market? What is the role of international banks? And what are the different techniques that firms can use to protect themselves from future changes in exchange rates, forward markets, and then the arbitrage activities. And this I've not actually discussed. Okay, what is hedging? What is arbitrage? You should know. And very little on euro currency.